You have money, congratulations. But here's the problem. You're not doing anything with it. It's just sitting there, under your mattress, losing value like a sad houseplant you forgot to water. Meanwhile, someone else needs money, desperately. They want to start a business, buy a house, pay for school, keep the lights on. They have plans. They just don't have the cash. So how do these two people find each other? Enter the bank. A bank is basically a matchmaker. It takes money from people who have too much right now and gives it to people who need some right now, and charges both sides for the privilege. That's the whole business model. Everything else is just details and spreadsheets. Let's start at the beginning. You walk into a bank. You deposit $1,000. You think that money is just sitting in a vault with your name on it, collecting dust until you come back for it. It isn't. The second you hand it over, the bank gets to work. Here's what they actually do. They keep a fraction of your deposit, maybe 10% as a reserve. The rest, loaned out to someone else. That person spends it, it lands in another bank. That bank keeps 10% and loans the rest out again. And again. And again. Your original $1,000 doesn't stay $1,000. Through this chain of lending and redepositing, it effectively becomes $9,000 or $10,000 floating around the economy. New money, conjured from math and trust. This is called fractional reserve banking. It sounds insane when you say it out loud, but it's been the backbone of modern finance for centuries. The reason it works is simple. Not everyone comes back for their money at the same time. You deposit $1,000. You probably won't need all of it tomorrow, so the bank bets on that. Most of the time, they're right. When they're wrong, when everyone panics and shows up demanding their money simultaneously, that's a bank run. The bank collapses. People lose savings. Chaos follows. It happened constantly in the 1800s. It happened in 1929. It almost happened in 2008, which is why governments invented deposit insurance. In the US, that's the FDIC. Your deposits up to $250,000 are guaranteed by the federal government. Even if the bank implodes spectacularly, you get your money back. This one invention basically ended bank runs overnight, because panic needs uncertainty to survive. Remove the uncertainty, no panic. Okay, so banks take deposits and make loans. But how do they make money? Simple, the interest rate gap. They pay you 2% on your savings. They charge someone else 7% on their mortgage. That 5% difference, called the net interest margin, is their profit. It's the oldest trick in finance, and it works every single time. But loans aren't all the same. Banks make all kinds. Mortgages, long-term loans to buy property, secured against the property itself. If you stop paying, they take the house. Hence the word mortgage. Auto loans, same concept but faster. Default and they take the car. Personal loans, no collateral, just your word and your credit score. Higher risk for the bank, higher interest for you. Business loans. Banks lend to companies to fund operations, expansion, equipment. This is a core engine of economic growth. When businesses can borrow cheaply, they invest, hire, and build. Credit cards. Technically a revolving loan with a terrifying interest rate, usually 20% or more. Banks love these. Most people don't read the fine print. Those two facts are related. Now, not all banks are the same. There are a few types you need to know. Commercial banks are what most people mean when they say bank. They take deposits, make loans, offer checking accounts, ATMs, the full civilian package. JP Morgan, Bank of America, your local credit union, all commercial banks. Investment banks are different animals entirely. They don't take your deposits. They operate in capital markets, helping companies raise money by issuing stocks or bonds, advising on mergers, trading assets. Goldman Sachs, Morgan Stanley. These are the banks that wear expensive suits and cause most of the famous financial crises. Central banks are a different species again. They're the bank for banks. The Federal Reserve in the US, the European Central Bank, the Bank of England. They don't deal with regular people. They set interest rates, control money supply, regulate commercial banks, and act as a lender of last resort. Meaning, when commercial banks are collapsing and no one else will lend to them, the central bank steps in. It's the financial equivalent of a parent bailing out a teenager who made catastrophically bad decisions. Let's talk about interest rates, because they run everything. When a central bank raises interest rates, borrowing becomes more expensive. Mortgages go up, business loans get pricier, people spend less, businesses invest less. The economy cools down, inflation slows. When they cut rates, borrowing gets cheap. People buy houses, businesses expand, money flows, the economy heats up. This is monetary policy. It's the most powerful economic lever in the world. and it's controlled by a committee of economists who meet 8 times a year and try not to break anything. The rate they set, called the federal funds rate in the US, ripples through every financial product on Earth. Your mortgage rate, your car loan, your savings account return, the yield on government bonds, the valuation of every tech startup, all of it traces back to that one number. Get it wrong and you get 2008, or the 1970s inflation spiral, or Japan's lost decade. Central banking is hard. Nobody gets it right all the time. Speaking of 2008, we have to talk about what banks did to nearly destroy the global economy. Here's the short version. Banks made mortgages, including to people who very clearly could not afford them. These were called subprime mortgages. Then investment banks took thousands of these mortgages, bundled them together into complex financial products called mortgage-backed securities, slapped them with misleadingly high credit ratings, and sold them to investors worldwide. Everyone assumed housing prices would keep rising forever. They didn't. When the housing market collapsed, those securities became worthless. Banks that were holding them suddenly had massive holes in their balance sheets. They stopped lending to each other. Credit froze. Businesses couldn't borrow. People lost jobs. The whole machine seized up. The US government bailed out the largest banks with $700 billion of taxpayer money. Several countries entered deep recessions. Millions of people lost their homes. The banks responsible paid fines, restructured, and went back to business. The lesson: banks are interconnected in ways that aren't always visible. And when confidence breaks, it breaks fast. Financial regulation exists precisely because of moments like this. Whether it's ever enough is a different conversation. Now, a newer threat, or opportunity, depending on who you ask. Digital banking and fintech are eating into what traditional banks do. Venmo, PayPal, Revolut, Wise, Stripe. These companies now handle payments, transfers, lending, and even savings products, some without a single physical branch. And then there's crypto. Decentralized finance, DeFi, promises a world of banking without banks. Smart contracts instead of loan officers. Blockchain instead of ledgers. No intermediaries, no fees skimmed by the middleman. In theory, revolutionary. In practice, still mostly a volatile frontier with spectacular collapses every 18 months. FTX, Terra Luna, the list grows, but the pressure is real. Banks are slower, more expensive, and more bureaucratic than apps built by 30 people in a warehouse. The future of banking probably looks like a hybrid. Regulated institutions with digital-first infrastructure, competing with agile fintechs that are slowly, reluctantly getting regulated. So, what is banking? It's the infrastructure of trust. It takes the messy, dispersed savings of millions of people and channels them into the loans, investments, and projects that build economies. It lets a small business owner in Vegas borrow money today that didn't technically exist yesterday. It lets you buy a house over 30 years instead of saving for 30 years first. Done well, banking is one of the most powerful tools for economic development ever invented. Done badly, with greed, opacity, and no guardrails, it's one of the most efficient ways to transfer wealth from the many to the few and occasionally light the global economy on fire. The difference usually comes down to regulation, transparency, and whether the people running it remember that on the other side of every balance sheet, there's a person. And that's banking, all of it. Donate by commenting and liking the video.